Hey there, finance aficionados. Welcome back to Bite-Sized Finance. Today, we're embarking on an exciting journey to understand the delicate balance between risk and reward in investing. Our mission is to help you achieve your financial goals while staying cool, calm, and collected. Don't forget to give this video a thumbs up for the YouTube algorithm, and be sure to subscribe and hit that bell icon for more fantastic finance content. Part 1. Risk versus Reward, the epic battle of investing. Before we dive into the nitty-gritty, let's define risk and reward. Risk is the likelihood that an investment will lose value or not perform as well as expected. It's the dark cloud hanging over your investments, threatening to rain on your financial parade. Reward, on the other hand, is the potential for an investment to increase in value, providing a return on your investment and the sunshine after the storm. Now, it's essential to understand that all investments come with some level of risk. Even the so-called safe investments like government bonds have a touch of risk. The key is to find investments with a level of risk you can handle and align with your investment goals. Part 2. The trade-off, walking the tightrope between risk and reward. The relationship between risk and reward is often depicted as a trade-off. The higher the risk, the higher the potential reward. For example, stocks are considered riskier than bonds due to their potential for dramatic value fluctuations. However, stocks also boast the potential for higher returns than bonds over the long term. So, how do you walk the tightrope between risk and reward in your investments? Let's find out. Part 3. Diversification, the superhero of your investment portfolio. One way to balance risk and reward is by diversifying your portfolio. Diversification is the superhero of your investment portfolio, swooping in to save the day by spreading your investments across different asset classes, industries, and even countries. This strategy helps minimize the overall risk of your portfolio, because if one investment underperforms, others may offset that loss. Part 4. Investment plans, types, and market cycles, the three musketeers of investing. Another way to balance risk and reward is by having a well-thought-out investment plan, understanding the different types of investments available, and investing at various stages of the market cycle. Different types of stocks have different levels of risk and reward. For instance, blue-chip stocks tend to be less risky than small-cap stocks, but they also have a lower potential for high returns. Similarly, investing in real estate can be less risky than investing in crypto, but with lower potential returns. Investing at different stages of the market cycle, such as growth stocks during an economic expansion phase and value stocks during a recession phase, can also help you balance risk and reward. Part 5. Time horizon, the time-traveling companion of investing. When considering risk and reward, your time horizon plays a significant role. Generally, the longer the time horizon, the more risk you can afford to take. This is because long-term investments have more time to recover from market downturns. Short-term investments, on the other hand, are more susceptible to market volatility and require a more conservative approach. Part 6. Financial advisors, the trusted sidekicks in your investing journey. A financial advisor can be an invaluable sidekick in your investing journey. They can help you understand your risk tolerance, craft a portfolio that aligns with your investment goals and risk tolerance, and provide valuable insights on market conditions, economic trends, and other factors that can affect your investments. Remember, even superheroes need a trusty sidekick. Part 7. Conclusion, becoming a master of risk, reward, and achieving your financial dreams. In conclusion, understanding the relationship between risk and reward is crucial for successful investing. By diversifying your portfolio, having a well-thought-out investment plan, understanding the different types of investments available, investing at various stages of the market cycle, and having a longer time horizon, you can balance the potential risks and rewards of your investments to achieve your financial goals. Remember, investing is a long-term endeavor, and it's important to have patience and not panic during market downturns. Keep in mind that it's not a get-rich-quick scheme, and one should not invest more than they can afford to lose. It's crucial to maintain a well-diversified portfolio and have realistic expectations about the returns on your investments. We hope you found this video informative, finance aficionados. If you did, make sure to subscribe to our channel and click the bell icon to be notified of new content. And don't forget to like this video, as it helps the YouTube algorithm show you more of our content. Until next time, keep your balance on the tightrope of risk and reward, and may your financial dreams come true.